We have reached a framework to implement the Geneva Consensus and the call between the two presidents.
In the past 2 days, China and the US teams had in-depth exchanges. Our communication is very professional, rational, in-depth and candid. Both sides have agreed in principle to a framework for implementing the phone call between the two leaders on June 5th and the consensus they reached in Geneva.
The US and China saying they have arrived at a plan to make things work around the consensus reached last month in Geneva, but they still need the sign-off from Presidents Trump and Xi. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into stories that matter with crucial context and sharp analysis. Markets are taking the US-China trade talks outcome with a pinch of salt. The lack of detail or a concrete agreement have investors remaining cautious. We'll ask whether trade tensions between the two largest economies can ever reach a lasting solution. Joining us, former Assistant U.S. Trade Representative for China, Jeff Moon. Meanwhile, U.S. Treasury Secretary Scott Bessent, who led the trade talks with China, is now being pushed as a possible successor to Fed Chair Jay Powell. More on this Bloomberg scoop ahead. As those trade talks between China and the U.S. gave some hope for tensions to ease, investors are still awaiting the details of the agreement. And the focus is on the shipments of rare earth minerals and magnets being eased by China. However, the breakthrough being dampened by a U.S. appeals court allowing President Trump to continue enforcing his global tariffs. The ruling extends a reprieve for the administration as it presses a challenge to a lower court that blocked the levies. Let's get more details on the U.S. and China's preliminary trade plan to ease tensions and revive the flow of sensitive goods between the two countries. Our Chief North Asia correspondent Stephen Angle joins us now in Hong Kong. Steve, we know that these are really high-stakes negotiations. We're short on details. Is this really a breakthrough?
I think it is. Obviously, things got off a little off track following that truce 4 weeks ago in Geneva, where they did come up with this agreement to reduce the temperature and to also continue to talk. But things spiraled downwards a little bit with the United States, basically implementing further export controls. And then the White House saying that China did not come through with its pledges to expedite the licensing process for critical rare earth and rare earth magnet exports to the United States. There was some accusations flung across the Pacific. Bad blood rose up again. So for these two sides to have very high-level talks following, of course, that phone call between Xi Jinping and Donald Trump last week, where they kind of reset the temperature, brought the temperature down, and agreed to move forward. And then the marching orders to their respective agencies and negotiators and working groups were to get things done. So they've agreed, they have a consensus in a framework agreement to go back to what they, in principle, agreed to in Geneva and move it forward. And they spent 2 full days, essentially, 6 hours on Monday, and then a real full day from 10 a.m. to just past midnight Tuesday in London to come up with a general understanding. Now, does that mean the rare earth exports are going to be flowing and the U.S. is going to be backing off on their added export controls? Well, maybe not yet, but it sets the stage for that. This is what Howard Lutnick, the Commerce Secretary, had to say on the steps of Lancaster House in London following that second day of marathon talks.
We do absolutely expect that the topic of rare earth minerals and magnets with respect to the United States of America will be resolved in this framework implementation. That is a fundamental part of that. Also, there were a number of measures the United States of America put on when those rare earths were not coming. You should expect those to come off sort of, as President Trump said, in a balanced way. When they approve the licenses, then you should expect that our export implementation will come down as well.
And again, I don't want to downplay the importance of that phone call last week between Trump and Xi. They laid the groundwork for the two sides to come to this framework agreement and then really putting the fire to the feet of the working groups and the subsequent talks to get the details hammered out.
Steve, you talked about two thorny issues, rare earths and U.S. tech exports. There is another one, whether or not the U.S. will allow Chinese investment in the U.S. That's also key.
Well, sure. I think there is room for that kind of opening up of markets on both sides. It has to be reciprocal, and it has to be within the framework of CFIUS, the national security investment reviews. That's also getting a bit into the weeds right now because, again, there has to be a bridging of the trust deficit. And that is something the Vice Commerce Minister, who we just heard from just a minute ago, Li Chenggang, who, along with He Lifeng, leading the Chinese delegation, he said he hopes that this consensus on the Geneva Framework Agreement allows or is conducive to building trust. I think there has definitely been a growing trust deficit between the two sides. That's why we saw the Geneva Agreement unwind so quickly. And that is why it really was needed to have Xi and Trump speak to each other to set the groundwork for these subsequent talks. Keep in mind, though, Haslinda, on this particular matter, because these are questions. What you just asked me is a similar question to what Jameson Greer and Howard Lutnick were asked by the gaggle of reporters. And Greer was the one who said, look, we're just concentrating right now on this framework agreement and getting Geneva back on track. Everything else will come into play subsequently once we have this consensus agreement. So we might be getting ahead of ourselves on the bigger picture idea about allowing more Chinese investment into the U.S. and vice versa into China. But right now, it's a good step. The clock is ticking, though. August 12th is when that pause on tariffs with China expires. July 9th is when that pause expires for other trading partners.
A trust deficit on top of the trade deficit. Steve, thank you so much for that. Our Chief North Asia correspondent, Stephen Angle there. Now, joining us now is Jeff Moon, who served as Assistant U.S. Trade Representative for China Affairs under the Obama administration. He's a founder of China Moon Strategies, a consulting firm advising private and public sectors on U.S.-China relations. Jeff, good to have you with us. Put this in perspective for us. We know this is a significant step in the right direction. It is an off-ramp, but to be sure, there's still a lot of work to be done.
Well, first of all, I thought Stephen Angle's analysis was outstanding. I agree with what he said. I do think this is a major step forward. I think that it was remarkable that within just a couple weeks after Geneva, the negotiations got completely deadlocked on really a subsidiary matter. This is not a core matter. Rare earths is not a core matter in the long-standing U.S.-China trade dispute. And I think the reason why they deadlocked is distrust. Distrust exerts very strong downward pressure on the U.S.-China relationship, including the trading relationship. And I think that things deadlocked because both sides assumed the worst motives on the other side. There was not the flow of rare earths that was expected, and I think the American side assumed that there were negative reasons for that. And there were other countermeasures that the U.S. Put in place, and the worst assumptions were placed on top of that as well. So that's why they needed to have a presidential phone call. That's why they needed to get together in person. You know, normally they negotiate by teleconference. They don't need to get together face to face, but they needed to in this case. And despite the fact that they've apparently agreed on something over many hours, we really don't know what it is. My experience with Chinese negotiators is when they agree in principle, you are closer to the beginning of the negotiation than you are to the end of the negotiation. And the questions that I have about Lutnick's comments that you just played is Lutnick seemed to suggest that the Chinese will go first in terms of action, and then the Americans will go second. And I wonder if that is the consensus on the Chinese side. So those are just among the many questions that I have about where we go forward.
Jeff, you pointed to the the lack of trust being key to negotiations, then you got to wonder whether the agreement that they've come to can endure beyond 24 hours. Remember that both sides were accusing each other of violating the agreement, which they came to soon after they made that agreement. So this flip-flopping has gone on for a very long time.
It has. I think that after all of this drama, it's about time to move on and start doing some real work. And I think that that we are on track. The fact, though, that both leaders have to ratify this is important, and then we'll decide what did they agree to. I mean, for example, with rare earths, did the Chinese just agree to use best efforts to provide rare earths, or did they agree to provide a certain quantity? Or did they agree to provide more staffing for this new licensing process where they have, 10,000 applications and 30 to 60 people to go through them? I mean, what is it that's actually going to happen there? And the same kinds of questions apply to the measures that the Americans have put in place as well. I mean, what's going to happen with visa policy for Chinese students, which is of great concern to the Chinese government? And with regard to export controls, there seems to be some indication of some flexibility, but I doubt that that means that NVIDIA chips are going to be included in this deal. So the devil really is in the details, and I hope that enough details are resolved that they can get to the real issues. And we do have that August 12 deadline for coming up with some kind of an agreement, and that's the real task in front of them. They need to get to that.
For China, the export controls is key. We heard from Kevin Bessent, as you said, suggesting that, there could be an easing of those controls. I'm just wondering, this was never on the table before. The fact that it is that signaling something different?
It definitely is. This is not a part of U.S. policy. The U.S. has never linked export controls with trade in this way. And so I'm a bit puzzled. And when I heard Kevin Hassett talking about it, I wondered at first whether that was an authoritative statement. He's the director of the National Economic Council, which has nothing to do with export controls. And yet he was just the person that was on national TV last Sunday, the designated person from the administration. It seems that based on Lutnick's comments and based on the fact that the Commerce Undersecretary, who actually has responsibility for export controls, was at Lancaster House, that suggests that somehow this is on the table. And I think that this is a really important issue because one of the other things that occurs to me with regard to Chinese policy on rare earths is the Chinese have a habit of granting, quote, concessions and then reselling them over and over and over again. And I wonder whether in the future, pledges to provide rare earths are going to be sold over and over and over, and there will be sort of an attempt to go down a slippery slope and get to more and more export controls as those negotiations go on. So maybe I'm mistaken in what I'm previewing here, but we can foresee that there are going to be further discussions on this.
Jeff, is it fair to say that it's really complicated, right? When you take a look at this trade war between the U.S. and China, yes, not new, but when you take a look at what's being weaponized here, including, as you mentioned, visas, it's going to be really difficult to come to any kind of resolution.
Yes, I mean, what's unfortunate here is that, from the big picture, we've gotten our best look at what decoupling looks like, and it looks really ugly. And fortunately, we are stepping back. But what happened after Geneva, and there were suspicions that the Chinese were somehow manipulating the export control system that they have, the U.S. started coming up with more and more choke points on the U.S. side. And this is a downward spiral. Both sides can come up and manufacture, an increasing number of choke points. And fortunately, I hope one of the lessons the two governments have learned from all this, and the reason they'll get back on track, is that going down that downward spiral hurts everyone, helps no one in the end. And so why don't we try to do something positive? But you're right. These issues, the core issues that I was referring to before, have been on the table for 30 years. I mean, I've been involved with U.S.-China relations for 30 years. I can't remember a time when we weren't talking about Chinese steel subsidies and overcapacity and dumping in foreign markets and loss of foreign jobs. I mean, these are perpetual topics, and it will be very tough, I agree with you, to come up with a resolution. Certainly not a comprehensive deal by August the 12th. And I agree with Scott Bessent, who said a few weeks ago that any kind of comprehensive deal would take certainly several years.
And Jeff, isn't it also true that damage has already been done, and perhaps we're underestimating the impact of the damage and how enduring that might be?
I think there definitely has been a lot of damage. I mean, there has been economic damage, there has been political damage, there's even been cultural damage. When you talk about people-to-people exchanges and visas and things like that, I mean, in U.S.-China relations, the easiest thing to do when you want to improve relations is to have people-to-people relations. U.S.-China relations started with ping-pong diplomacy, and the Chinese frequently will talk about how we ought to have people-to-people relations. If we're damaging even those kinds of elements, then we are really getting to a very broad scope in terms of how things are getting off track. And I think trade is the sharp end of the spear, but there are a lot of other aspects as well.
Talk to us about how trade will be rerouted. As it stands now, we know China is bypassing all the tariffs, using the likes of Vietnam, Malaysia as, points for the goods. How might this play out even further?
Well, this is the trade war bleeding over into other countries and other markets. And this is another core issue that the U.S. is taking on, not with China, but with other countries. For example, it's in the press that there have been talks with the Vietnamese, the Malays as well, and they've even had, I think, customs training programs that they're putting into place to deal with the country of origin rules, because a lot of goods are coming in from China, and the country of origin is being declared as Vietnam or Malaysia in those cases. And I think that there's pressure from the U.S. government to prevent that from happening. And so I think this will be one of those issues that's going to play out over years as we go forward.
And for companies, Jeff, what does it mean? Is it about being agile, because policy shifts would mean a lot of, movements in terms of sourcing, pricing, and where you invest?
Well, my advice to companies is to move incrementally. Do not overreact to every development that comes down the road. If you had done something dramatic as a result of 145% tariffs, then you're very sorry that you did that. So move incrementally, think in terms of, broad trends. I think that a lot of American companies are moving out of China. A lot of them are moving to adjacent countries or friendshoring. Some are coming back to the U.S., but this tariff situation is completely unpredictable and makes it really hard. I mean, it really even frustrates Trump's own desired ends. He wants to bring factories back to the United States. But how can you plan to bring factories or even bring goods back to the United States when you don't know what the tariff is going to be tomorrow or a week from now or a year from now?
So in the end, decoupling, although undesirable, perhaps inevitable to an extent.
I think limited decoupling. Well, we've seen that in this recent spat, we've seen that both countries have things that the other needs and can't do without. So decoupling is absolutely impossible. We need to find some way going forward. That's why I think that there will be some kind of a mini deal by August the 12th. I think the model is the US-UK agreement, which was a 5-page term sheet. It even said in the middle, you can see it on the USTR website, it even says this is not a legal document. I think there will be something along those lines. And the things that will be agreed to will be things that are easy, that both countries probably already want to do anyway. And it will be things like fentanyl. So we'll see.
Jeff, great insights. Jeff Moon, founder at China Moon Strategies and former U.S. Trade Representative for China Affairs under the Obama administration. Now, still ahead, U.S. Treasury Secretary Scott Bessent returns from the tariff talks with China as Bloomberg reveals a growing push for him to succeed Jay Powell as Fed chair. Keep it here with us. This is Bloomberg. Well, Bloomberg has learned that Treasury Secretary Scott Bessent is emerging as a serious contender to succeed Jay Powell as the next Fed chair. Our senior U.S. economics and government editor, Derek Wallbank, joins us now for that Bloomberg scoop. We know Bessent is a star in Trump's administration, but he already has a job.
He has, and it's a very important job too, right? As Treasury Secretary, he has all of the things that would normally entail. But Scott Bessent is also one of the key people in terms of trade talks with China, trade talks with the rest of the world, as we're in the middle of this 90-day pause, and the U.S. is negotiating reciprocal tariff deals with a small army of nations around the world, right? Japan and India and Israel and all sorts of others. So he has a lot on his plate right now. But this is a position that, Jay Powell's term runs until May of 2026. Donald Trump has said he is thinking about who should replace Powell. He's said that he's close to a decision that we may find out very soon. He has at least a name or names in mind. So this is an appointment the president's taking very, very seriously. And look, this is a president who has been very willing to be clear about what he thinks the Fed should do. He has derisively named Powell as too late as a nickname, and has said very clearly he wants the Fed to move more aggressively on cutting rates.
Well, it does seem like Bessent has the support of the markets, right? I mean, he's looked at favorably. But the question really is whether he's qualified for the Fed job. His expertise is not in monetary policy.
Well, I think that the guy who's making the ultimate decision, Donald Trump, would say that he has some ideas on monetary policy as well, right?
If the president is deciding anyways, it doesn't really matter.
I think the key thing that you have to look at here is that Bessent is somebody who's viewed as a serious person by markets. He's somebody who is not seen as someone who is just some random ideologue. He is seen as somebody who would be very seriously taken. But there are other names as well, right? Kevin Warsh is a name that we've heard mentioned quite a lot for Fed. There are other names there that we've seen mentioned that markets would take seriously. But certainly Scott Bessent is somebody who I would say the president feels that he's done a good job.
Fed independence has been key. It's one area that people have been looking at. If Bessent were to take this position, you've got to wonder whether that independence will stay or he'll veer more towards what Trump wants him to do.
Well, I think anybody who would go into a position like that at this moment right now would face questions from market leaders about what the independence would look like, given that Trump has said very, very clearly, I want rates down. Rates should be cut now. They should have been cut before, and I'd like them to be cut at quite a steep level, right? So I think anybody who's coming in will face questions, and in any sort of confirmation process would face questions about what they would do at the point in time when the president gets on his Truth Social account, invents a nickname for them, and says, I think that you ought to be doing something different, right? So I do think that that's going to be a scrutiny as we go through this appointment process, whether it's Warsh, whether it's Bessent, whether it's anybody else. That's a question that I think all market watchers are going to have.
And also we'll know soon enough. Derek, thank you so much for that. Our senior U.S. economics and government editor, Derek Wallbank. Still to come, we take you to Bloomberg Invest Hong Kong for a live discussion on India's position as a rising star in the global wealth market. Keep it here with us. This is Bloomberg.
Those individuals have diversified portfolios and are well advised and they're financially secure. We go all the way to the other end for the average investor. The average investor is going to want something that
Welcome back. You're watching Insight. Bloomberg spoke to Hong Kong Financial Secretary Paul Chan just about an hour back. He spoke about the financial hub's performance in the first quarter amid the trade tensions. Take a listen.
The outcome is somewhat expected, but there are bound to be volatility, ups and downs. So we won't underestimate the challenge. For us in Hong Kong, concentrate on doing the right thing. On the one hand, ensuring financial security, financial stability, and on the other hand, in terms of international financial center status, in terms of our trading hub status, as well as a rising technology and innovation hub, we concentrate on these three fronts to move forward to drive our economy to continue to grow.
What are your expectations for the economy this and next year?
This year, the estimate GDP growth is 2 to 3%, as indicated in the budget. The first quarter performance was impressive, 3.1% growth. Export strong, private consumption a little weak comparatively, given the changing spending patterns of Hong Kong residents and incoming visitors. This is understandable, and we help the industry to transform, to reinvent themselves to respond to this change. This will take a little time. Investment also sustained. Into April and May, the figures currently available, exports still holding up, investment still quite good, stock market is doing quite well, and the pipeline is strong. So we expect this year the stock market will continue to be strong, and this will give support even to private consumption.
Right. The wealth effect, as they say, in fact, quite timely. It's almost like we planned it yesterday at the close. The Hong Kong stock market, specifically the Hang Seng China Enterprises Index, actually entered a bull market as of the close yesterday. It's almost like we planned it. We'll just say we planned it. We'll just say we planned it. On the market side of things, one of the big highlights this year has been the return of big listings in Hong Kong. We have had a massive one, CATL, a few weeks ago. Just give us a sense of what's in the pipeline.
Well, CATL is a classic example, drawing a lot of attention, and also, the DeepSeek moment, causing the foreign investors to reassess, number one, the technical capabilities and innovations on the mainland and the possible investment options. Number two, people find that perhaps earlier on, last year, say, for example, they had underweight their allocation to this part of the world. So you saw funds flooding in. We have looked at the IPO pipeline, very strong. On the one hand, given the geopolitics, it is getting more difficult for tech stocks, say, for example, to go to the US for listing. Then if they sit for international listing, Hong Kong is natural destination. And also, as you mentioned, the return of the China concept stocks. I've already asked my colleagues in the Securities and Futures Commission and the Stock Exchange to get well prepared for them to come back to facilitate this listing.
Should we expect more big listings this year?
More to come, actually, more to come. The pipeline is very strong, and also the central authorities are very supportive of this move, encouraging the mainland major companies coming to Hong Kong for listing.
That was Hong Kong Financial Secretary Paul Chan speaking at Bloomberg Invest Hong Kong earlier today. And those trade negotiations between the US and China in London seem to be giving a bigger push to Hong Kong equities than US futures. Our strategists believe there's more room to run for shares in the city. Avril Hong has more. Well, they're going to jump. The question is how high?
Yeah, I mean, we've already been seeing them on this pretty solid run, right? So just flagging how we're seeing onshore, offshore Chinese shares, they're doing well today. CSI 300 is having its best day in about a month. And this is against the backdrop of these trade negotiations. US futures, we saw them slip earlier. Our MLive strategist, Mark Cranfield, making the point that Chinese sides have kind of come off from these London talks, and they're seen as having not had to give up very much in order for these trade negotiations to continue. So it looks like on the Chinese side, they sort of have the upper hand in things. And if you look at the trading patterns today, right, when it comes to the rare earths, the minerals, related stocks, those are the ones that are a big boost to mainland equities. Now, flip the board. To your question about how high things go, you look at this chart courtesy of MLive's Mario Nicola, and we've already been seeing a really solid rally on Chinese equities. What's important amid all this is that it's come despite the sluggish eco data. So this gives you a sense that when it comes to Chinese stocks, is it bad news is good news. She's actually making the point that the MSCI China could actually be turbocharged on the back of any improvement when it comes to data, because there's been a positive correlation with this gauge and stronger than expected data. Now, flip the board, we're also keeping an eye on Indian stocks as they are set to open soon. We've been seeing futures looking pretty flat, but Indian stocks have sort of gotten their groove back on the past couple of sessions, especially after the RBI's surprise jumbo cut. The Nifty has also formed the golden cross, another positive signal. Take a look at foreign investors buying of Indian stocks. That's turning positive for this quarter after a couple of quarters of selling. Abhishek Vishnoi of our stocks team has sort of done the analysis going back a decade, and that's usually a signal of an extension of foreign investors buying of Indian stocks. So a positive signal for Indian stocks as well, Has.
Back to being bullish. India. Avril Hong, thank you. Now let's head to India managing editor Jeanette Rodriguez live at Hong Kong Invest, where she's moderating a panel on the rise of India wealth. She's joined by Waterfield Advisors Dijev Chopra, Kotak Mahindra Bank's Gautami Gavanka, and ASK Assets Sunir Rohakali. Let's listen in.
You have the main hubs, Delhi, of course, Bombay. But you're seeing massive growth coming from the tier 1, tier 2 cities, the smaller cities, so to speak. You also have a massive pool of HNIs growing there. That's really the biggest growth opportunity in the country. How does a firm really build scale in India to realize the potential of that very fragmented but very large market?
Good morning, everybody. I wanted to tell you first that I represent Kotak Mahindra Bank, which is the third largest private sector bank in India. Otherwise, the context will not be clear. We cater to retail customers, wholesale banking customers, so corporates, and then also to the high net worth, ultra high net worth individual customers. Because we are a banking platform, we are able to cater to the entire length and breadth customers in India. To answer your question, Janet, most importantly, we have a branch presence across India because of the banking network, and thus we are able to cater to tier 2 and tier 3, that is the next in level cities in India. But what becomes most important for us is, are we going to be able to build enough branches across the country to be able to reach? The answer probably is no, because you will have a cost implication because of that. So what we have done is for the retail customers, and I'm bringing that point because it becomes relevant here. For the retail customers, we have created technology platforms where an ability to onboard on the banking platform is done digitally, an ability to invest through our technology platform is done digitally. So the involvement of a human element to that extent is reduced, and thus very critical to achieve scale. And scale can only be achieved if you're using technology by your side. So that's our retail strategy. We feel that this segment is going to exponentially grow as well in India, as we heard from Sunil, the kind of numbers that we are looking at. Then you come to the private banking or the UHNI segment that we all deal with. Now this segment again is growing exponentially because of the fact that one, there are a lot of IPOs which are coming up. Second, because there's a lot of sales which are happening of India Inc. And that happens because you have reached immense valuations and you want to cash out. It also happens because of the generational shift which is happening in India and probably in any country. You see the next generation is not necessarily interested in running the businesses which their parents or their grandparents created. And thus you see a lot of sale of businesses which happen, and thus the growth in the wealth segment is again big. For that segment, we are very clear, it's going to be a model which is a combination of tech and human intervention. If I am speaking to our ultra high net worth individuals, he's not going to be extremely happy looking at the reports that we submit on a mobile app. He will need interactions. And this is an assumption or a belief that he will need interactions. We have to go to the levels that AI is going to probably question all our jobs, okay? But having said that, with innovation, with proper products that we kind of curate for these set of clients, by ensuring that we are able to add value by intervention of a human angle in it, we are trying to use both the models, the digital model and the human model, to ensure that we are able to reach the customers at length. The strategy that we have created, Janet, at Kotak's is we've segmentized our clients. Became very important because each client needs, basis their segments are very different. So today as we speak, we have a professional segment which caters to the professional clients, chartered accountants, lawyers, doctors, which are growing a lot in India. The ultra high net worth individuals segment and the high net worth individual segments. Additionally, we also have a segment which is called the non-resident Indian segment. We see a lot of interest of people who have left India 2 decades back or 3 decades back, living in US, Canada, UAE, Singapore, Hong Kong, who are interested in Indian markets, who understand the Indian markets, who have families and friends in India who made tons of money in the Indian markets. And thus the interest that is there in India is humongous. We know of ASK here who have funds set up outside India to get money into India. We have Kotak funds set out outside India to get money into India. So this segment is again growing. So we are looking at it segment-wise to ensure that we have products which will cater to every segment, and we make a seamless entry into India for NRIs and people in India. We are trying to segment and create niche practices for catering to each segment.
Thank you, Gautami. Divij. Gautami, of course, massive wealth management services with Kotak. You have a very influential advisory service. And you speak to all of the client ranges really that Gautami spoke about, both in India and outside. What are the key questions that your clients are asking you? What are the problems they're trying to solve within the Indian market?
Yes, absolutely. And I think for a context, so I work with a boutique investment advisory firm. So our main client base is in the HNI and the ultra high net worth segment. I predominantly look after the latter as well as family offices. So again, very high touch segment. The landscape that has been very well articulated by Sunil in terms of the macro and the structural changes that you're seeing in India is something that we're facing. And we see a big shift away from, tier 1 cities, the major metros, Delhi, Bombay, as you alluded to, remain extremely important, but there is a big development of wealth that's happening all across the country, tier 2 cities, tier 3 cities, and for us it's a very exciting opportunity. The questions that we see families coming to us with, irrespective of where they're from, and as you know, within the high net worth and the ultra high net worth segment, there is a commonality in terms of problem statements that they come to us with. The way Indian wealth management has been historically distributed across to clients remains very fragmented. So most clients come to us having multiple wealth managers. And so the first problem that they want to solve for is truly understanding what their overall exposure is, being able to see and manage their risk a little bit better. So even something as simple as help us with our MIS and our consolidated reporting. That's a starting point. Secondly, a lot of the families are also multi-generational. And with that comes very different kind of solutions that you have to kind of solve for. Here we're talking about transference of wealth from one generation to the other. In more established multi-generational business families, you would go so far as helping them in terms of setting up structures for succession planning, estate planning, but then also coming into helping create more of a framework, a governance system, a family governance or a family constitution, so that they have certain rules of engagement in which they can operate on. And these families also, whether it's tier 1, tier 2, you're seeing them also becoming more multi-jurisdictional. You'll have families where children may go overseas, they stay on, they go to college over there, decide that they want to spend a little bit more time overseas, maybe not necessarily be part of the business. And with that, it leaves for different problems or challenges that need to be solved for the clients, because different jurisdictions come with different regulatory nuances that have to be solved for. Toughest, obviously, is if a client's child goes and settles in the US. The kind of planning that we have to do there is very different. But multi-jurisdictional families in terms of the own family construct, as well as now how families are wanting to also develop global allocations as part of their portfolio. And India has predominantly, we have very strict capital controls, but there are enough solutions that are there that the government has approved, which allow us to have conversations to actually start helping clients also develop overseas allocations. This is part of a portfolio diversification tool. It's a currency diversification, and the global markets play a very important aspect. Further to Gautami's point, we also see a two-way flow. So you have Indian clients who are keen to invest overseas, but one of the reasons we're all over here is there's so much interest from offshore, not only the NRI community and the Indian diaspora, but also global investors who are looking how to access India, and how to access India in the right way, with the right partner, make sure that governance is there, transparency is there. So we are also seeing a lot of interest inbound as well that we work to solve for. Another problem that families often talk about, the Indian wealth management industry has been predominantly, as I mentioned at the start, distribution-led, which means the solutions that are given to investors across are driven by product commissions. And today, 58% of the wealth management industry is actually through this distribution model, and only 14% is on advisory. If you look at the US is only 2% in terms of distribution, and almost 60% in terms of advisory.
The rise of India, that conversation happening in Hong Kong at Bloomberg Invest Hong Kong. Of course, subscribers can watch us live and see our past interviews on our interactive TV function, and that's TV Go. You can also dive into any of the securities or Bloomberg functions we talk about and become part of the conversation by sending us instant messages. And tomorrow, we'll be joined live by Kotak Mahindra Bank President Gautami Gavankar. That's as we dive deeper into the wealth management industry in India. Plenty more ahead. Keep it here with us. This is Bloomberg.
The relationship is complex. There are challenges that can't be eliminated in a couple of months, of course, but there are things we potentially could do. So, I just think we feel positive about engaging with the Chinese, understanding the real challenges.
U.S. Trade Representative Jamieson Greer there after talks with China. The latest framework trade agreement struck between the two countries in London marks another cautious step toward easing tensions. But Bloomberg opinion columnist Karishma Vaswani thinks it's only a fragile truce that could be reversed at any moment. Karishma joins us now. And of course, we've seen this before, right? Because it's not, you say, it's not a reset. It's just a step in the right direction.
Absolutely, Haslinda. And, in my column, I talk about the fact that we've seen rapprochement before, but it's turned into recriminations, right? So this time round, I think what we've had in London is positive, but it's precarious. And the reason for that is that on both sides, the issue of trade is now being viewed and sort of negotiated through the lens of national security. And what that means for China is that every single aspect of this trade deal, the Chinese are going to be thinking, well, hold on, the US see us as a strategic rival, as a competitor, and they're trying to stamp down on our ambitions across all aspects, whether or not it's from the economic perspective, but also from the defense perspective. For the Trump administration, they've been really clear. This is how they deal with trade in the new era. So I think for there to be lasting long-term progress, you're going to have to see compromises on both sides, and that's going to be very difficult.
The approach is also different. I mean, we know China wants respect. We've heard that over and over again, but, you know, the Trump administration is so focused on showing how they're strong. So that could be a conflict there, right?
Completely, and you've hit the nail on the head. You know, in my research for this column, I was speaking to people from both the China side as well as the US side, and one comment really struck out for me, because the issue is who can sort of hold the game for longer, right? And Xi Jinping in China has a political system that allows him to sort of suffer the pain a bit longer, and there's a lot of narrative right now that's very appealing to the Chinese public about the fact that even though there is this economic hit from the US, it is because the US is trying to keep China down. So there's a lot of nationalism that's being bolstered amongst Chinese citizens. On the flip side, you've got the United States, where for now at least, it feels like the economic hit, they're willing to suffer. There's a lot of bravado and, you know, that sort of strongman language that it's got to be other countries that come to the negotiating table, including China. But politically, you know, it is a precarious situation if you have prices going up beyond what Americans want. And that might be something that the Trump administration is wary of as well. So I think that's the long-term standstill that we're in, where both sides aren't blinking quite yet.
However you look at it, it is a rising China, and increasingly the U.S. has to coexist. You know, the question of coexistence is huge, and how are you looking at that?
Well, you know, it's the thing I scratch my head about every single day when we sit down to sort of, you know, come up with a framework for how these superpowers are going to deal with each other in this new era. And I think that's the most important thing to bear in mind. We've seen the strategic rivalry, not just in this administration with Donald Trump, but I think it started well before that, in the first trade war. And no matter what happens with this particular trade deal, that rivalry is not going away. It won't be resolved.
All right, Karishma, thank you so much for those insights. Bloomberg opinion columnist Karishma Vaswani there. Now, before we go, here's a big story for K-pop fans across the world. BTS members Jimin and Jungkook have been discharged today from the South Korean military. They're the 5th and 6th members of the boy band to complete mandatory service, adding to expectations of a musical comeback. Talk about excitement there. On Tuesday, 2 other members, RM and V, completed their service. They wore their military uniforms to greet fans, some of whom had traveled from as far away as Mexico, Brazil, and Turkey. The 7-member group put their music career on hold in 2022 to fulfill their duties for varying lengths, as long as 18 months. BTS fans still have to wait until June 21st for all 7 members to be free. The last one, Suga, is fulfilling his duty as a social service agent, an alternative to military service. The stock of their production company Hype has rallied in recent days since news of BTS's imminent comeback emerged, shares touching their highest level since April 2022. And that is it for Insight. Keep it here with us. This is Bloomberg.